Hi, everyone. Welcome back to Your Money Matters. I am your host, Angela Giroux, and I wanted to share some exciting news. This Friday at 2 p.m., Ted will be hosting a YouTube live event. Please make sure you tune in. It's our first time doing it. We're very excited. Of course, he can't give personalized investment advice, but he will be answering questions and giving one of his great, of course, presentations like he always does. So make sure you tune in, mark it on your calendar, Friday, 2 p.m. Eastern Time. We hope to see you there. Now, Ted, before we get started with today's topic, I did want to put you on notice that you are not the only one who has cool t-shirts. Clint and I have decided
the coolest ones. Okay.
Clint and I decided to give you a run for your money for a change.
Right, well,
so
we'll
for those
see.
of you watching, we want to know which one you like best. Catalina wine mixer. So please comment below and let us know. But of course, it's not all sunshine and rainbows today. We record this on Friday. Amazon released earnings and basically took the entire NASDAQ down with it. The Robinhood IPO debuted this week and nothing short of a disaster, I guess you could say. So Clint, is this just another sign that this party is over for these kind of growth stocks?
I have to say, Honey Badger don't care about Amazon earnings. Yeah, I mean, so
Honey Badger does care.
Honey Badger does care.
Honey Badger's got some money in Amazon. Honey Badger down 7% today. You know?
Well, okay, that's a great segue because at that point, Amazon down 7%. That is $110 billion. That is wiped off of its market cap. Now, if that were a standalone company, the amount of money that they've lost off their market cap today, if that was a standalone company, that would be larger than 422 other members of the S&P 500. That's about the equivalent of a CVS Health, just to put in perspective and why, Amazon being down, 7% doesn't seem like an astronomical figure, but it's dragging, the S&P and the NASDAQ down by a considerable amount. Once again, just because of its sheer size. So, why is Amazon selling off today? Well, it looked like they had blowout.
Before you go on, Clay, how many spaceships is that worth?
I don't know. That's a good question.
I think it's got to be a lot. But anyway, sorry to interrupt you.
No, all right. So they had another quarter of blowout sales. I think this is the third quarter in a row that they've put up over 100 billion in revenues. But this most recent quarter, they came in, I think I wrote down here, about 113 billion in revenues, but that was shy of what analysts were looking for. They were looking for about 115. But then more importantly, when you start to look out for the next quarter, the top end of their guidance range was for about $112 billion. That was well below where analyst estimates are right now at around 119. So the issue here is that the pace of growth is moderating, and some of it is tough comps, so tough comparisons from last year against, the pandemic. But just to show you where the numbers have been and where they're expected to go, here's a chart of Amazon's quarterly sales growth rate just compared to the prior year. So I took this back to 2019. You can see year over year, they were running at around the 15 to 20% range. Pandemic comes along, that number gets supercharged. You see them running, upwards of around 45% for several quarters. And now you see kind of looking out here, going ahead, looking forward, that number is dropping off sharply. Now we're coming back down to this 15 to 20% range over the course of the next year, which, that's not necessarily a bad rate of growth, 15 to 20%. But when you're paying 55 times next year's earnings, you start to question, is that enough to justify? Here's a quick chart of Amazon's price to earnings ratios as a forward PE. They're the blue line. Going back several years, trading at 55 times right now, compared to their peer group median, the red line is at 20 times. So, once again, just with these moderating growth rates, I think you're seeing with other growth stocks as well that are reporting earnings this quarter. It's a question of whether or not they can keep up that pace, and if it justifies the valuation multiples that you're putting on them. And then, the other thing we saw this week, separate but related, was Robinhood's debut, their IPO. If you look at the size of their IPO and compare it to others, I think there's 51 other IPOs of similar size. They had the worst debut ever. They dropped just over 8% from their IPO price. Just to put that figure in perspective, when you look at all IPOs historically, On average, the first day is usually a pop of about 33%. Only about a quarter go on to have a loss. So I think a part of it's just supply and demand. So supply and demand sets the price of everything, right? And there's just a lot of supply from IPOs coming online. Here's a chart that shows how much money has been raised annually, going all the way back to the .com era via IPOs. And you see back around the year 2000, we're topping that 100 billion level. We're hitting that mark once again. So there's a lot of supply coming to market. The ability of the market to absorb all that maybe is being called into question. But so these things together, I think what you're starting to see is the confidence is starting to go away, and the ability for the market to keep moving higher here, especially amongst retail traders. And this is the last chart I have to show what I'm talking about here. So Sentiment Trader puts this together. This is the smart money versus dumb money confidence indicator. So that the red line is a proverbial dumb money that tends to be more retail traders. The blue line is your institutional crowd. Supposedly the institutional crowd is better at timing markets versus what retail can do. But this just tracks how confident they are in the market. This is going back about a year or so. And you can see this, once again, these confidence levels in the red line, the retail crowd just continuing to moderate. But what I think is interesting is that the blue line that's been just absolutely buried, the smart money is starting to recover here and is moving a little bit higher. So maybe there are some other opportunities that are coming up in the market.
So speaking of those opportunities, Ted, I'm going to turn to you. So may not be a good idea for these growth stocks right now. Amazon, Robinhood, I know it certainly got me spooked. So what might be a better idea given all of these circumstances right now?
Well, I think just to reinforce something that Clint said earlier, that Amazon dragged down the whole index. I mean, that's what's going to happen. When the top 5 firms, constitute something like 30% of the index. I think, it's just, you're just at the mercy of these massive firms. So they are growing. I mean, there's no doubt. I mean, the amount of money that they're raking in, I mean, 20% is great. I mean, that's the cutoff, right? But when you get used to something, that's higher than that, even that's a disappointment. So I think the critical thing is that, as I've been saying for a while, when you get to this kind of point in a market cycle, there's really nowhere to go but down, at least when it comes to the majority of stocks. Obviously, you can find opportunities. That's what we try to do in the Bauman Letter. But one thing that you can do in this environment is to look for income. And I'm a big fan of income. My own portfolio, I mean, I build my portfolio around solid income producing positions before I start using any other money to play, more aggressive, more risky things. Now, one way to do that, and something that we're going to be talking about in the Bauman Letter, is closed-end funds. Closed-end funds have actually been around since the late 19th century, but they tend to be ignored by the financial press because they seem to be hard to understand, but they're not really hard to understand. Basically, a closed-end fund is like a mutual fund that trades on the stock market. They work that they IPO, they collect a bunch of capital, they IPO, they issue the funds kind of like a SPAC. But instead of merging with another company, they use those funds to invest in companies just like we do. But the thing is that they can do it in a way that actually generates quite high returns. And in some cases, it's tax advantaged. They're different from mutual funds and ETFs because those can, they can accept new money all the time. So their value changes all the time. But a closed-end fund is closed because once they've raised their initial pot of capital, that's it. So you know what you're getting with a closed-end fund. Now, the pros are that they can benefit from leverage. They can borrow money against their holdings and use that to generate outsized returns, which ETFs don't do, and mutuals don't do. So basically, you got that. But they also use option strategies. They mainly use covered calls because they own the underlying assets and they're writing calls on those. And they can basically arbitrage that in such a way that they can beat the market, even if their underlying holdings are not increasing that much. In other words, they can actually generate returns in excess of the market using those leveraging strategies. But one of the key things is that you don't get sell-offs. Like with a mutual fund, if somebody, if investors pull their money out of a mutual fund, then the value of that fund for everybody falls. That doesn't happen with the CEF because it's just a share price, right? And now the key thing for me from a tax perspective, also with closed-end funds, is that if they're smart, they can use the option strategies in a way that means that part of what they pay out as quote unquote dividends is actually a return of capital. And that means that you're not taxed on it because you're getting back something that theoretically you put in, but they do it in such a way that it doesn't erode the underlying value of their fund. So closed-end funds are what I like. I'm going to give you some examples just now, but there are some things to be aware of. They're not as liquid. So, they tend to be a little bit more volatile than mutual funds and ETFs. They have higher expense ratios than ETFs, but they're lower than mutuals. But their yields tend to be in the 7 to 8 range, which is great. And the other thing is when you buy one, you want to make sure that you don't buy it at a premium to its net asset value. What they do is they publish what's the value of their holdings right now. If the current market capitalization of the closed-end fund is above that, then you want to be careful. You want to look for dips. So I like the idea of closed-end funds, and here's why. Here are 2 closed-end funds that I think would make anybody happy. One is the Eaton Vance Tax Managed Global Diversified Equity Income Fund. That's a mouthful. Ticker EXG. It's a 7.23% dividend paid monthly. So if you compound that in an environment where a lot of people are saying that the stock market as a whole may actually be flat or even down over the next 5 years on an annual basis, this is a great strategy. I mean, once you compound those monthly dividends, you're going to beat the market. Another one that Clint and I both like is the Reaves Utility Income Fund. It's a UTG, pays 6.5% dividend also monthly. And here you've got the opportunity to invest in a fund that is targeting precisely the sectors that are going to benefit from this infrastructure bill that looks like it's going to pass. So, that means the underlying value of its holdings are going to rise. That means its share price is going to rise. It'll make more money. It'll raise that dividend. So you've got growing dividends. You've got good yields. You're compounding them monthly. You're doing great stuff. Now, I'm going to give you 2 additional other things here for dividend, just because I like giving things away on Fridays, and I want everybody to vote for my T-shirt, so I'm going to give these. One is the Crestwood Equity Partners 9.25% preferred partnership preferred. It's basically a preferred stock. The ticker is CEQP.PR or -PR, whatever your broker uses. It's a 9.1% paying preferred, and it's uncallable. It's unique. It cannot be called. So basically, theoretically, they could pay out 9.1% in perpetuity. So, you invest $100,000 in that, you're going to be getting, $90,000 in income just forever, basically. Now, obviously, nothing works that well, but that's a pretty good opportunity. The last one is also what I like to call baby bonds. A lot of people call them baby bonds. A lot of business development companies issue baby bonds. And one is called Eagle Point Credit. They have notes that are due at the end of 28. The ticker is ECCX. It's a 6.6% return. So these are all things that you can do right now, as if we've reached the top, if we've reached a turn to income, folks. And especially if you're young, buy this stuff in your retirement account or buy it in a Roth IRA and let it compound. And then when it comes, you'll have a lot more than if you're trying to play the Robinhood game, as we've seen.
Right. And Ted, as you mentioned, you do have another recommendation coming soon for Bauman Letter subscribers. So if you're not a subscriber, now is the perfect time to join us.
Yep. And a hint, it's a CEF. It's a very, very good one, yielding very, very good money on a monthly basis.
And a final reminder, again, on Friday, 2 p.m. Eastern time, please join us. Ted will be streaming live from YouTube and taking your questions. So hopefully we'll see you there Friday. Thank you so much for joining us today.
Don't forget to vote for the T-shirts.
Catalina Wine Mixer.